Hi, everyone. So today it's Friday. We're wrapping up the first trading week of the year and just emphasizing our video from last week. We entered the new year positive on the market. However, we did feel that we're in an extremely overbought condition. And sure enough, we thought within the first several weeks we'd see some sort of a pullback, perhaps quite steep. We did get some volatility early in the new year. The first week we're down about 3% across the S&P and NASDAQ on average. Pretty good pullback for about 4 trading days. We have moved from an overbought to a slightly oversold, not meaningfully so. It's a very mild correction. So I'd be surprised if this thing is over and we may see more downside. But, we just want to emphasize, true to what we thought would happen, we saw a pullback right in the early weeks of the new year. Why does this happen? Well, number one is that all of the major institutions, these portfolio managers are kind of judged and analyzed based on what they're holding at the end of the year. So they really kind of hold them into over the calendar year. If they sell it in the last few days in anticipation of a correction, it won't show up in their annual reports that they send out to all their investors. Second of all, it's just, why would you sell in 2024 when you could just wait another week or two or another month to throw it into a 2024 year capital gain? Markets were up so much last year, investments were up so much that if you want to trim back, you will have to pay the capital gains taxes in April, just a few months from now. But if you waited until this week, you would be able to pay those taxes in April of 2025. So you actually hold on to your money for another year and a quarter, which can remain invested for you and working, or put it in a 5% treasury. That's it. So again, we continue to be positive. We're still on a little bit of a warning. We did a major rebalance this week in all of our core portfolios. We went back into small caps, which we sold at the beginning of 2023, which underperformed that year. We expect them to do better as the economy stabilizes and the Fed is done raising rates. We are adding mostly small cap value, but we did add some growth as well. We are maintaining or slightly increasing our large cap value positions, dividend paying stocks, and we're kind of fading some of the big cap tech stocks and a lot of that growthy stuff. We're really whittled down our international. We've taken it from about 15% down to about 8% in terms of our weighting there in both developed, international, and emerging markets. And that could be a short-term mistake. We're going to keep a really quick trigger finger on getting back into that stuff. The international markets are by far the cheapest sectors out there in stocks. So, but again, we just see most of the growth happening in the U.S. given our presidential election year and where our Fed is. The entire year is going to be based on how Jerome Powell, the Fed chairman, reacts to economic data and uses proper forecasting and handles rates aggressively ahead of the markets. My biggest concern is that they wait too long to cut rates if things are really slowing down. So we're going to have to see what happens, but a lot of this year is going to depend on the Fed acting well. Our outlook that it's going to be a positive year, somewhere between 7-10%, maybe the back end of the year we get up 15% in the major averages, is all based on the fact that the Fed in the next 6 months is going to start cutting rates, not because the economy is in so much trouble, but because the economy is decelerating and you want to stop it before it kind of goes into a recession. So that's where we are first week, just as the playbook, as our playbook was looking for, and we feel really good about our outlook for the rest of the year, or certainly for the rest of this quarter. And we'll take it quarter by quarter and month by month, and we'll be broadcasting more to you. So everybody have a great weekend. Bye.